Hi everyone, my name is Nico Yun and I'm the intermediate accountant here at Versapay. I've been working here for, I would say, approaching 8 months now. However, I studied and worked all my career in the financial space.
What are the main challenges or obstacles you see accounts receivable teams facing when processing and paying invoices on time?
Yeah, so being here for roughly 8 months, I would say that definitely each entity within Versapay sort of has its own unique processes to get the invoice, let's say, out in front of the customer and for them to obviously pay in a timely manner. As you can imagine, there are several opportunities for friction, not only internally, but externally that can cause these delays. From invoices not being sent out to correct email address, from inquiries, let's say, on charges on their certain statements, or let's say they have, certain credit cards that are expiring and we need to update that on the credit card. All of these scenarios at the end of the day does require communication. And at the end of the day, sort of a human touch to reach a conclusion.
What impact does an inefficient collections or payment experience have on your relationship with vendors?
Inefficient collection experience does cause friction on both ends. I think speaking from an AR perspective, it does affect cash flow and let's say dependency on the client to pay on a timely basis, which obviously may strain the relationship from the client to the point of, let's say, no return. From the vendor perspective, they may have several reasons why they're not paying, which is, again, it does require human touch to address them, right? This all leads to essentially how we're able to create an environment that human touch is essentially fostered, and that's basically all dependent on the platform or the way we communicate to them.
With so many KPIs at their disposal, how can accounts receivable teams determine the most important ones to track?
Yeah, so some of the KPIs the finance team, I would say, currently utilized are, I would say, first and foremost, the aged account receivables and days sales outstanding, which essentially provides insight into which accounts require follow-up for outstanding invoices. Again, this all turns back into how it affects cash flows. In terms of determining which KPIs to use is obviously dependent on its intended goals and outcomes desired in the process, right? I would say an example is operationally, it's really important that we maintain cash flows that it's aligned with what's expected to, let's say, our budget. And similarly, long outstanding invoices may indicate maybe, it might uncover that clients are dissatisfied for the services offered, which we'll need to address accordingly.
In what ways can an over-reliance on traditional finance metrics hinder a comprehensive understanding of accounts receivable performance?
Traditional AR metrics is, simply that they're basically a set of calculations from a set of reports that provide, I would say, surface level insight on the overall health of cash flow. Obviously, digging deeper, an over-reliance on these metrics does cause an oversight to the underlying issue, which may be several. I guess one of the examples is it's possible for a company to, let's say, have amazing low days sales outstanding and, very, very preferential aged accounts receivable. But let's say when we look at their cash flow and it's lower cash flows and revenues than expected. In this case, we might find that there were errors in generating invoices for that month, or let's say the invoices that were generated were not done correctly and were all underbilled, which obviously our clients would be happy to pay for those. In this case, it's clear that, let's say, greater controls were needed to be issued at the time of billing, which will not be found out from just assessing it from, let's say, an AR collections perspective.
The impact of accounts receivable on customer experience is often overlooked. What other factors or insights are not considered by conventional AR metrics?
Yeah, so I would say speaking on some non-traditional AR metrics, not considered, maybe let's say average time to resolve billing inquiries. That would also involve, let's say, average dispute resolution times, accuracy of invoices, or on the flip side, let's say percentage of on-time payments. Depending how AR or accounts receivable essentially handle these inquiries, these metrics are, I would say, more often harder to measure, both objectively and subjectively, but that does not mean that they're less important. It just means they're harder to measure.
What should finance teams measure to unleash the full potential of their accounts receivable?
So I'm under a strong belief that finance teams should consider both, let's say, traditional and non-traditional metrics to measure AR performance. And at the end of the day, they have to address the underlying issue that stems internally within the departments or externally with the clients. While there are many metrics out there, determining which ones apply, let's say, to the current objective and needs of the business is crucial, as that will sort of be essentially the benchmark for measuring performance over time. From there, being able to address those underlying issues will create sort of an adaptive and a flexible business environment, which is obviously very important in today's landscape.
What does a high-performing accounts receivable function look like?
A customer experience-driven mindset, to me, is what drives optimal internal processes. So AR and billing is one of the few departments where we have consistent interactions with the client. And that's unfortunately not to give them something, but rather us telling them, hey, pay this invoice on time. And taking this into account, for me, an ideal customer-driven experience from a billing perspective is one where there are no surprises. So essentially where the client is expected to be billed on a certain amount even before the invoice is generated, and they have the funds to pay in a timely manner. And AR should basically be doing whatever they can to facilitate that.
How does a high-performing accounts receivable function contribute to the overall financial health of a company?
Yeah, the overall goal of AR function is to improve the overall cash flow of a company through facilitating payments of outstanding invoices. A healthy financial cash flow means customers are, paying on time, they're reducing bad debt, and overall increasing operational capacity, which ultimately contributes to the company's goals of being self-sustaining.
How is accounts receivable performance improved by better communication between AR and AP teams?
Yeah, so accounts receivable and accounts payable do share the same issue, obviously just opposite sides of the spectrum. Improved communication between these parties does help accounts receivable facilitate sort of where the efforts are needed. I would say, for example, payments of commissions from a partner can be halted if accounts receivable is not doing their due diligence and, let's say, collecting the cash flows from the merchant, so that we can have those cash inflows to pay out the partners, which is obviously the cash outflows. So the faster that sort of communication can be made, the faster resolution we can have and have those payments allocated.
What trade secrets or tips do you have for improving accounts receivable performance?
A customer-driven mindset should be sort of the benchmark of what drives AR performance and internal processes. And collaborative AR is a perfect example of that, where obviously this hub facilitates the communication between both customers and its vendors. That leads to essentially greater transparency and, where expectations are being met for both parties, which leads to more timely payments and AR performance as a result.
What are some tactical and strategic things that all AR teams can do today, in the next 3 months, and in the next year to boost their accounts receivable performance?
So every AR team sort of has its unique challenges that hinder their AR performance. And I think for me, it's first important to identify the root cause of those deficiencies and address them. In my experience, one of the common issues I see is a lack of streamlined communication standards to the client and the accessibility of that information that's been communicated, let's say cross-functionally between departments. I think first and foremost, companies have to remember that communication is done from a business to business. So every point of significant contact should be readily available across teams that need that information in order to best respond to the customer needs. Once we find out what the customer needs are met, then payments will follow. Last but not least, obviously boosting AR performance does also come with how we address those boosting AR performance does also come with how we address those customer needs. Whether they want to dispute a bill, let's say adjust payment information, or require specific forms to be filled, a standard process on sort of how to handle common inquiries will reduce response times and increase customer satisfaction.
How can finance teams develop a system of reporting that's right for their unique business?
So understanding business objectives will help with identifying where financial reporting can provide meaningful insight to support decision making. I would say, for example, a business in its growth stage would want greater insight, let's say, on their revenue or year-over-year sales, which is driven by its conversion and churn rates. I would say, looking at the opposite side of the spectrum, a business where its objective wants to be more conservative, they would want greater insight on their margins and cash flows to, let's say, meet their debt obligations. Once those objectives and needs for specific financial reporting is met, it's all about gathering that data necessary to provide a meaningful report to assist in those decision making. And also facilitating those controls and safeguards to validate, let's say, the accuracy and the consistency and the completeness of that data. That all comes from essentially choosing which type of software technology or automation tool that best fits, let's say, the scopes and objective of the business.